everyone, and a very good evening. You're watching The Money Show on ET Now. I'm Ubina Kapasi. This is the show where we get you your daily dose of personal finance news that you need to know and get you on the right path to wealth creation. Whether it's saving money or spending money in a better fashion, we have got you covered. Well, and also, of course, let's not forget, we will be answering your questions and queries as well. Our email address is themoneyshow@etnow.tv. Let's tell you what we're going to discuss in today's episode of The Money Show. It's going to be all about taxes. What can you do? And when I say what can you do, I mean really last minute, what can you do kind of questions that we will help you answer in order for you to help you cut down your tax bill for FY21, that's March 2021. In just between today and tomorrow, what can you do to ensure that your tax bill is cut down to the minimum? We'll help you with that because it's very unlikely that FM Sitaraman is going to grant you an extension just like she did last year. So we'll be talking about this, and also we'll be discussing all the new income tax laws, rules that come into effect from the 1st of April and for the fiscal year 2022, especially those announced by FM Sitaraman. So all of this will be discussed along with your questions and queries. So let's bring on board our very first guest. We have Mr. Balwant Jain, tax and investment expert, joining us on The Money Show today. Mr. Jain, thank you so much for taking our time and, joining us on the show.
Thank you.
So to start with, Mr. Jain, it's literally we are down to the, to the T with just the last 2 days left to ensure that, we can do our last bit to cut down on the tax bill. However, is there really a way out? Is there something that taxpayers can do between today and tomorrow that will help them to, cut down their tax bill for the fiscal year 21?
First, I will tell what one should not do to save the tax. First, one should not buy life insurance policy just to save the tax. And unless you need to have a protection cover for your family. Secondly, even if you wish to invest in ELSS, which gives you better returns, one should not invest significant amount in lump sum. So these two options are ruled out. The options left for saving tax are still available with you. You can invest in senior citizen saving scheme. You can contribute towards public provident fund. You can buy NSE. You can go for a tax saving FD also, where the returns are fixed, so that it is not impacted by the volatility of the equity market.
Mr. Jain, we often discuss ATC, we speak about PPF, ELSS, but I think the other sections which many of our viewers may not even be aware of that are available under this large bracket of Chapter 6A are often forgotten. So if you could just talk about those lesser known tax deductions as well for the benefit and for the knowledge of our viewers.
First of all, people are aware about NPS deduction, which is generally available up to 1 lakh along with the other items under Section 80C and 80CCC. But only a few people are aware that NPS offers you an exclusive benefit of 50,000 contribution under Section 80CCD 1B, which is otherwise not available. So one can contribute an additional 50,000 over and above 1,50,000 and avail this benefit. The other benefit which is available to the central government employees and which people are not aware is contribution towards your Tier 2 account. The deductions under NPS are available only for the contribution towards Tier 1 account, but central government employees are allowed deduction under Section 80C within the limit of 1,50,000 if they contribute towards this 80 NPS Tier 2 account. There are some items which people are not aware, like you can claim deduction for stamp duty and registration charges under Section 80C. Likewise, almost everybody is aware about deduction under Section 80D for Mediclaim, but only a few people would be aware that in case a senior citizen does not have a health insurance policy, you can claim up to 50,000 rupees for day-to-day medical expenses incurred for his treatment. And this deductibility of this provision is that this deduction can be claimed by the senior citizen himself, his or her spouse, and all his children. So in case there are significant expenditure, everybody can avail the deduction. One more deduction which people are not aware about is in respect of rent paid by the people who are not receiving any HRA benefit. So this deduction is available up to 5,000 rupees every month for which you have paid rent for the accommodation which you are occupied. These are the few deductions which are available, which only a few people are aware about.
And the reason that we highlight this for our viewers as well is because you may have sort of realized that, okay, I need to ensure that I am cutting down my tax bill. But there are many, tax saving instruments that it would not be possible for you to invest in between today and tomorrow, because do remember that tomorrow is also the bank account closing date. So banks may either be shut over tomorrow and day after, or they may be having minimal operation. So there are certain investments you will really not be able to do because it is so last minute. So the moral of the story is, firstly, get into action at the beginning of the financial year as opposed to the end. And the second is, and that was the reason behind asking this question, is that I'm sure there are certain payments which Mr. Jain has mentioned that you may already be making. For example, the last example with respect to rent, that is actually available as a deduction for taxpayers, provided you are not getting HRA. So if you are not salaried, let's say you may be employed as a consultant, or you may be a freelancer, or you may be a small business owner, the rent that you pay for your home is actually available as a tax deduction. So you need not really scamper at the last minute. Sum up all of this and see if it's giving you a good enough deduction from your total income, then maybe you don't need to really run around, at the last minute. I think that's really the reason why we decided to talk about this. And Mr. Jain, I would like to stress a little more on the bit around loans. Again, this is something that many may not be aware of, but if you could just talk to us about all the provisions in the Income Tax Act with respect to home loans, of course, that help our viewers cut down on their tax bill.
Okay, so the benefit for home loan is available for principal repayment as well as for the interest payment. The principal repayment benefit is available only if you have taken loan for specified institutions for buying or constructing a residential house property, and this is available under section 80C within the overall limit of 1,50,000. The other benefit is available in respect of interest paid on money borrowed for either buying, constructing, repairing, renovating your house. The property may be residential or even maybe commercial. The money may be borrowed from your even friends and relatives. Home loans from institutions are already included in. There are restrictions on up to which you can claim the deduction. If the property is self-occupied, nowadays you are allowed to have 2 self-occupied property. So you can claim up to 2 lakh. And in case the property is let out, you can claim the entire deduction, but the loss under the house property income is allowed to be set off against other income up to 2 lakh, and beyond which the same is allowed to be carried forward for set off in subsequent years. In addition to this 24B, you are allowed a deduction of 1,50,000 interest paid for buying an affordable house, a residential house, provided you do not have any house property in your name and the loan has been taken from financial institutions between 1st April 2019 and 31st March 2022. So these are the broadly benefits available for home loans.
I actually have a follow-up question on something that you mentioned in the first answer, and that is when we spoke about last-minute tax saving tips, ELSS as a product. When we do subscribe to, or rather we do purchase units of ELSS, I may subscribe to it today, or rather I may purchase the units today, but by the time it may get credited to my, account, that may happen day after tomorrow. So, from a more practical point of view, keeping aside, of course, the point that you mentioned that right now, the market's very volatile, so it may not be the best last minute tip. But from that practical point of view, will, even if I make an investment today in ELSS, will it be even eligible for my FY21 tax deduction?
So as per SEBI regulations, the units of in the mutual fund will be allotted on the basis of the realization. When the money is received by the fund house, the units will be allotted. So if you apply online by today or tomorrow, the units are allotted the same day based on the day's NAV, and you will be eligible for a deduction under Section 80C for such ELSS. But if you put in a written request through application and accompanied by a check, then I don't think you will be able to claim it, because the money will be debited from your account after 31st March.
So exactly, if you want to still go in for an ELSS, you'll have to do so online. You can't sit and submit a check, etc., because that will be subject to realization, and that may take a little while. But online is almost instant, right? So the minute the money is debited away from your account and into the AMC's account, the units have to be allotted or credited to you that day itself. So in that case, you can get the benefit of ATC, but otherwise not really. Okay, so that's everything to do with FY21. Like I said, folks, you just have the last 2 days left. Take stock of everything that you are already doing. It may be in the form of paying your EMIs, paying rentals, so on, paying Mediclaim, etc. Take stock of what you're already doing. Compare it with your income. If it is well and good, if you believe that you've exhausted everything, if you still feel there's a little room and maybe you can, put a little more in a PPF, or if you still feel you want to go ahead, maybe invest a little more in ELSS, then do so right now. But remember that you have to keep in mind all the other circumstances like Mr. Jain did mention. Okay, well, let's now move away from FY21 and look at FY22, which is just 2 days away. The FM made several announcements in Budget 2021. Just to jog the viewers' memory, Mr. Jain, why don't we encapsulate all those new rules that come into effect from the 1st of April?
I would discuss some major changes which are going to impact the individual taxpayers from next financial year. The first one is the option to have a new tax regime of lower tax is available you from 1st April. So either you can opt for the existing scheme of taxation, or you can go for lower tax rates. Many of the salaried would have exercised the option with their employer, but that option was for a limited purpose of tax deduction, and all the salaried can still reverse their choice after computing their tax liability, and they can again go back to either old or new, and the salaried have a privilege to exercise this option year after year, which is not available to person who derives income from business. So but for business people, you have to take long-term perspective in mind while taking this option, because there is no coming back. The second provision, which is effective for ITR, which you will be filing from next year, is that the dividends have become taxable. So all the dividends which have been credited in your account, in some cases TDS would have been deducted, in some cases, in case that payment was less than 5,000, no tax was deducted. So while filing your ITR, you have to gross up the dividend based on the entries in your 26 form in the respect of TDS. So these are two changes. The third change, which is coming into effect, is announced in this budget and is coming effect from next year, is that now normally you have a time till 31st March of the assessment year to either file a belated return or revise your already filed return. But the time limit has been curtailed by 3 months, and now you will have time up to 31st December only. So in case you file your return late, and you notice any omission or mistake, you will be left with a very few days to revise. So try to file your return as early as it is possible. One more change which is coming into effect, or rather has already come into effect from 1st February, is in respect of ULIP, in respect of which the aggregate payment during the year exceeds 2,50,000, then those will be taxed as a capital gain, and they will no longer enjoy exemption under Section 1010D. And the last most important amendment, which is going to affect all the salaried, is that in respect of your own contribution towards your provident fund account, if the contribution exceeds 2,50,000, if the employer is also contributing, and 5 lakh in case employer is not contributing, any contribution beyond these limits, you are free to contribute, but any interest which accrues on this excess contribution shall be taxed in your hands year after year, and you will have to offer that for taxation. These are the changes I think will impact people post 1st April.
You know what, we will take that last point forward, but before that, Mr. Jain, we'll just have to take a very short break, so stay on with us. Ladies and gentlemen, we'll be back. We'll also address your questions and queries, so send them in to us on the Money Show at etnow.tv. Welcome back. You're watching the Money Show on ET Now. We're in conversation with Balwant Jain. Now, Mr. Jain, let's talk about one particular, point, I guess, which will more so impact the high salary earners, contribution to PFs and ULIPs. Mr. Jain, I want to know your opinion on Provident Fund as a general retirement planning instrument and also as a tax saving instrument. Do you think that given this new provision, employees, high salary employees should consider rejigging their contribution to PF, or do you think that its value as a retirement instrument is too high for you to be worried about, its tax implications?
Momina, I feel that your financial goal should not be fully weighed by the tax consideration. You have to take tax implications into account while you take the investment decisions, but those should not be fully weighed by your tax consideration. So as far as contribution towards Provident Fund is concerned, Provident Fund, since our country does not have social security system, that we only have this Provident Fund account or NPS or PPF to contribute and make a retirement corpus for us. So you should not consider reducing your contribution just because the interest on excess contribution will get taxed. On the contrary, I feel that since the interest on excess contribution would become taxable, and effectively your the targeted contribution, the corpus would come down from what your target. Instead, you should rather increase your voluntary contribution towards your Provident Fund account rather than reducing it.
Okay, so don't be too worried about tax implications. You have to look at all these investments you make more from a holistic portfolio perspective. Yes, tax is a consideration, but it should not be one of the factors which may cause you to actually not consider an instrument, even though it's a great one. PF being one of them, given the fact that India does not have social security. Okay, time for questions and queries very quickly then. Let me remind our viewers, you can email us on the Money Show at etnow.tv. First up, we have a question from Tushar. Mr. Jain, he asks us, I have only short-term gains through sale of stocks and mutual funds. How can they be considered for advance tax payment? Interesting question here. You do advance tax payment before the financial year ends. Sometimes, of course, you don't know when you can realize these STCGs or even LTCGs for that matter. Mr. Jain, how should such individuals assess their advance tax liabilities when it falls due on the 15th of every quarter?
So for advance tax payment, normally, as you said, there are 4 due dates, and you have to pay a certain percentage of your annual income based on that. But in case of capital gain, the law have made some concession So in respect of capital gains, you have to pay the capital gain tax as advance tax in balance installments which fall due after your capital gains have been earned. So you need not worry, and this provision will become applicable even for dividends also from this year onwards. So you have to compute your capital gains every quarter and then rework the percentage of payments to be made as advance tax. Though the advance tax dates are all 15th of each quarter, but in case you have failed to pay your advance tax by 15th of March, you can still pay by 31st March, and the same shall be treated as advance tax, but you may have to pay interest at 1% for the shortfall of the advance tax payment.
Okay. All right. Well, I think that's all the time we have. So, Mr. Jain, we let you go on that note. Thank you so much once again for enlightening all our viewers on what they should look forward to in the new fiscal year. Thanks so much once again. Okay, and with that, we are out of time as well on The Money Show. So, thanks so much, ladies and gentlemen, for joining in. We'll wrap it up.